Futures Market Trading by www.profitabletradingtips.com. Futures market trading involves standardized contracts for buying and selling specific quantities of commodities, equities, or other financial instruments. Futures market trading of these derivative contracts allows businesses and speculators to hedge investment risk as well as profit from market fluctuations. There are futures exchanges located in nations around the world. Each has its own rules and procedures for standardized contracts and procedures for futures market trading. The quantity of grain in a wheat contract or number of shares of stock in stock futures contract may vary from market to market. However, the principles of futures market trading do not vary from market to market. In each locale, traders buy or sell the right to take or make delivery of the underlying asset as of the expiration date of the futures contract. As many use futures markets to hedge risk, they often exit their futures contract before expiration, either with profits in hand from a profitable future trade or because they have no interest in taking delivery of a herd of live cattle. The trader simply executes the opposite trade in order to exit his position. When a contract is created, it is referred to as open interest, and when a trader exits his or her position with the opposite trade, the open interest and contract disappear. Futures market trading for businesses. Businesses that buy or sell commodities, for example, use futures market trading to hedge investment risk. As an example, a gold mining company may be concerned that the price of gold bullion and their profits will fall in the coming year. The company will sell futures on gold bullion as a means of guaranteeing a given price for their product. Likewise, a company that buys a lot of gold may choose to purchase gold futures in order to have a set price for the coming year. The same works for agricultural producers and their buyers. Futures market trading for speculators. Many trade the futures markets in search of profits and not in order to hedge risk for an existing business. These traders pick and choose which things on which they want to trade futures. The advantage of this approach is that some parts of the futures market may be very quiet and some parts may be very volatile. It is the volatile market where futures market trading can be the most profitable for speculators. Futures market clearing, settlement, and options. Futures market trading proceeds in an orderly fashion because of the companies that guarantee efficient, orderly, and transparent trading. Settlement of trades is typically handled by institutions that guarantee payment and eliminate counterparty risk for traders. Because of the risk of a bad trade exceeding the ability of one party to pay the other, traders need to put money in a trading account and trade on margin. When potential losses approach the size of the margin account, the trader receives a margin call and must replenish his trading account or have his account closed and contracts sold. An alternative to dealing with margin accounts is trading futures options. In this case, the trader buys puts or calls on futures contracts. He or she only executes a futures trade if doing so is profitable. The extent of possible losses is the cost of the options contract. The latter aspect makes options a popular futures trading strategy. For more insights and useful information about trading stocks, currencies, or futures, visit www.profitabletradingtips.com.